Uh, Good morning. Is this on? Can you hear me? I am Steve Ireland, and I am a member of the I-7075 Board in charge of membership. So any of you who are not members, please see me, and we'll get you signed up. I am also tasked this morning with introducing our real estate panel, who are four gentlemen reasonably familiar to me because I have the privilege of working with them every day. I have on my far left Jerry Smith, to his right Tony Witt, to his right Steve Peters, and to Steve's right Aaron Savino. And these four individuals will provide an update this morning of our region, all things real estate, and all of them bring different disciplines to the table. Jerry and Steve are primarily involved in the industrial marketplace. Tony Witt is focused primarily in the office arena, and Aaron does a combination of all things office and retail. All bring a vast amount of experience to our discipline, and I'm pleased to introduce them this morning to have them discuss our region. Before we get too deep into that, I would like Aaron to sort of perhaps start, because Apex Commercial Group is a new entity that was formed out of two long-standing institutions here in the marketplace, and I think a brief overview of how that occurred would be interesting to all of us this morning. So, Aaron?
Thank you, Steve. Can everybody hear me? So, I don't know, maybe 2 years ago, Steve Peters and myself were talking about possibly starting a new company. Reason being, we saw kind of a niche in the market. Real estate's local. We saw a lot of larger national companies not necessarily focusing on Dayton as much as we did. And we worked with a lot of them. We were the neutral brokers in the market. We worked with a lot of them, and what we thought was, let's start talking seriously about starting something up. About that time, we looked around and said, well, who would we like to talk to join our company? I mean, if we do this together, who better to work with than our biggest competitor, which at the time was Tony and his office at Cushman & Wakefield. So what we decided to do was, about a year ago, is have these conversations regarding how we start this new company up, and who we want to be, where we want to work, and our focus being solely brokerage for now. You want to add anything to that, Steve?
Sure. It's a little different being up here after 27 years at Miller Valentine. I guess to add to it, the timing probably with some changes at Miller Valentine, refocusing on construction, which they're extremely good at. The property management company decided to spin off the asset management company, which is really who we worked a lot with, spun off a year prior to us starting this. So, with that timing of those two entities leaving, it allowed us to focus on brokerage because of the timing of Cushman and what they could do, and Miller Valentine to focus on more third-party construction. So the good thing is Miller Valentine's still a very valued customer. We have a lot of friends there. We still work there with them on a lot of projects, and but by combining these two groups, we've been able to provide better service for all of our customers with what we do best. So,
Tony, you want to add anything to that about
just real briefly, platform? Coming from a national platform with Cushman & Wakefield, really Cushman would never have an office in Dayton if it wasn't part of the legacy group that I was a part of through various mergers, starting with Larry Stein Realty. Some of you might remember that. We were part of Danis, and then we spun off into Colliers, which became Cassidy Turley, which became DTZ, which became Cushman & Wakefield. So I was with, since 1987, in those groups, never quit a job. We just, through mergers and acquisitions, ended up being Cushman & Wakefield. And Cushman is set up for big markets. Dayton, obviously, is not a big market. Their model fits guys that are producing $1.5 million, $2 million in commissions a year. Unfortunately, we don't do that in Dayton. But so the timing was right. And when Steve and Aaron approached me, and when I talked to the other guys, there were 6 of us that from Cushman that made the move. It was just made sense. and couldn't be happier being with a locally based company now. Fortunately, we still get a lot of the Cushman work because they don't have an office in Dayton, and they have no plans to restaff the Dayton office besides property management, which they're doing. So we're still working very closely with those Cushman leads, et cetera. So it's been very good.
I tried for 15 years to get Tony to work with me, so got lucky.
Don't move easy.
So what you're
Okay.
seeing behind us is the team. This is everybody. As you'll see, we've got, it looks like, what is it, 10 people from both companies together. And it's you know, with the amount of knowledge in the market, you know, the next slide will show you, or the slide previous, there's over 234 years or something of combined experience. So it's been, you know, it's hard to find, which is honestly, I think, has been the best thing. It's hard to find, you know, a deal that somebody hasn't seen in the market. So it's been great.
Thanks, fellows. I guess we'll just jump into the overview, and I don't know which one of you guys wants to sort of start off. We can talk about the various market segments, but, you know, maybe with you, Steve Peters, the industrial marketplace, you know, how do you view the current assessment and outlook for the Dayton region and the industrial market in general?
Sure. Well, industrial's been fun again. It's probably in our market, the hottest product out there. You've obviously read a lot about what's happening at the airport, but there's a lot of traditional properties in our market that are doing very well too. Those are the unique ones up there. We love having them come in, but that's not the bulk of the normal day-to-day business we do in Dayton. From a landlord side, it's really good. Rates are going up, vacancies are going down, and finally, we're able to push term on leases, which helps. Since improvement costs are going up, we're getting longer-term leases. We can do the improvements to the buildings to get the tenants in there. And I don't see that changing over the next year or so, luckily, with the demand we're still seeing. If you're on the tenant side, you got to be prepared to pay a little more rent finally. Sign up for more term. It gives them less flexibility, but you know, this all goes in cycles. So I think we're going to, you know, enjoy this from a landlord rep standpoint while we can. When you're on the tenant rep side, your job's a little bit harder, but you know, that's why we got the team we have. We usually can find something for the tenants. So was that chart up? Okay.
Yeah.
If you're looking at that chart, and this information's from CoStar, there's only a few items that I really look at on this that I think are relevant. The data is better than it has been in the past, but it's not 100. They mix in owner users and things like that, so you got to be careful what you're seeing there, but it's actually pretty close. Months on the market, I think, is a little long. If you have a quality building, typically it's not going to take that long. It may take a while to get the deal done, but typically you'll get a deal put in place, or at least starting of a deal, quicker than that time period.
Thanks, Steve. Hey, Jerry, can you speak to the market in terms of, you know, what sort of product the industrial users are looking for? You know, to give us a, you know, and maybe in terms of inventory. I know it's a little tight in the industrial marketplace.
Sure, Steve. I think right now people are almost looking for anything that's open. This is the lowest vacancy I've seen in my career, almost 25 years. So there's not a lot available, you know, out there. And it's become more employee-driven as far as amenities and location to attract employees. I mean, when things were tough here during the recession, people would commute quite a ways for a job, and they were, you know, just glad to find an opening. Now it's a very tight job market. I'm working with a manufacturer north of town that's going to air condition a very large manufacturing building, and the product doesn't require it. Normally, we see product driven when you need air conditioning. You don't see it. They're putting it in solely for the benefit of retaining and attracting and retaining employees, making it a nice place to work. You know, typically what people are looking for are higher ceilings, particularly in the warehousing market. We don't have a lot in Dayton. 19-foot clear is pretty much standard, a few 24s, but the new stuff going up to the airport's in excess of 30, and people really want that. They also want power. Manufacturing, power's gotten very expensive to add and bring in to buildings, particularly if you're converting a warehouse building to manufacturing. That's very expensive. They're looking for that. And they're also looking for more of a glove fit. Tenant improvements have also gotten expensive along with the increase in construction costs. So someone may find the square footage and location that works, but then when they add in the amount of office they need and power and maybe upgraded lights, and they start, it drives that price up almost to the point that they start looking at new construction. But right now, there's just not much available, and they're happy to find anything that comes close to their needs right now.
Are you, and this is to both you and maybe also to Steve as well, but what sort of, are you still seeing good activity and good interest in our marketplace, despite the tightness of the inventory? Are you getting lots of leads and that type of thing?
I'll speak briefly. The tornado, unfortunately, has driven a lot of people into the market, and they're not finding a lot out there. And a lot of them want to lease short term while their building is fixed. And in this market, it's become kind of a landlord's market, and they're looking for 3 to 5 year leases, and they're not too excited to do a short month to month or 3 month or 6 month lease. So I think that's going to create some problems. There's lots of interest. We show a lot of buildings to people because they'll look at anything that's close. They're out looking at. But I think overall it seems to be a little bit slower. But I think that's just because we don't have the inventory to show people. Steve, I don't know.
Yeah, I would agree. The hardest space to find right now is probably 12,000 to 40,000. Those have all been gobbled up pretty quick. So, there's a few out there, but none of them have the amenities somebody wants, meaning improvements need to be done to the space. By the time you do it, it drives the price up and makes the deal harder to do. I agree with Jerry. I don't know how many, I bet I've got 10 calls with what just happened on Memorial Day. And the challenge is, we don't have condominium space for 4 or 5, 6 months while somebody rebuilds something. It's something that, we're going to talk to our clients about to see if they want to, take a chance on short term, if we even have the space. But if you look at where a lot of that hit, those were a lot of owner users. They might have had some outdoor storage, Stanley in there, and a lot of those types of uses don't fit in a multi-tenant building. So there's challenges with the need for just by the dynamics of where that all happened. But if somebody needs larger space, you can find 70, I'd say 50 to 125,000 square feet and several options. But and then you go to the larger deals that are happening at the airport, which usually don't even hit the radar here. Those are coming in from out of state. They're usually deals that are already in place. Not those buildings. The first one was built spec. The rest of them that have been built so far have not been spec. They've had a user in tow. So, that's not really demand driven from here.
Right.
So.
Are you guys seeing any sort of trends or anything, new in the industrial marketplace in terms of what people are looking for? I mean, again, getting back to this tightness of the market, and the fact that maybe not so much spec stuff's being built, but just what if you could do something different or tell an owner what they should be doing, what maybe they should be building, or what type of product they should be providing?
Yeah, sure. We would, of course, we always want as brokers, we want tall ceilings we can get, most flexibility, most TI dollars we can get. But, Dayton is still that 20 to 100,000 square foot user predominantly. So even the older buildings we have with 20-foot clear height, we get by. If somebody's going to build something new, they're going to build taller ceilings. The challenge is to fit that size user is the cost to build that 150,000 square foot building, and backing into the rates you got to get, there's still too much of a delta between existing rents for current buildings and what it would take if you build the new ones. So we're not quite there. When you build 500,000 square feet at a time, 700,000 like they're doing at the airport, they can get their rent numbers down. It's just commodities of scale. So rents are pushing up. We're not quite there yet. I think it might, a little bit more time, rents come up a little bit more. We may see some building happen because we definitely are thin on inventory.
I just say that, just that delta there, rough gauge is, a lot of industrial buildings are selling that $25 to $30 a square foot range in this area. And to build it new, it's $60 to $80, a square foot. I'm talking under 100,000 square feet. That's one reason all those big buildings are being built at the airport. When you build 500,000 square feet, you can drive those prices down, to $45, $50 a square foot, and they can deliver lower rents. Also, when they're looking for construction, they're looking for tax abatement. That's one thing that's really driven that stuff up at the airport, is the pre-1994 Community Reinvestment Act, where you can get by with no taxes on the building for up to 15 years. And on a building that leases for, say, $4 a square foot, if you have to put another $1 in taxes on it, versus one that's got the abatement, they can stay at $4, and a competitor not in this area has to charge $5. You can see that they're going to fill up first.
Okay, thank you. Anything else that you guys want to add with regard to the industrial market before we move to office in terms of, the future, or do you think that it's going to be robust for the next couple of years, or?
I still think it's going to be good. Barring anything crazy that happens in the economy. But I did want to touch on the sales information that we did have on the chart. Jerry mentioned 25 to 30 bucks. I think that's a pretty good number. It depends on the building, obviously. But, we used to see these buildings trading at 20, some of the old 19-foot clear stuff. That's not happening anymore. I think 30 is more realistic. I don't agree with the average sale price. That's a little skewed by some things that have sold up at the airport, and that was from an investment standpoint. So, and also the market cap rates, you got to remember there's a difference between a cap rate on an investment building versus backing into a cap rate on an owner-user building. I think cap rates traditionally in Dayton are a little bit higher, meaning, probably closer to 9-10% because the credit of the tenants, we don't have national tenants in here, and there's a little more risk with them. The buildings aren't new. The airport buildings, when they sell, they're selling for less than 8% cap, but they have 15-year leases at a minimum, credit tenants. The traditional stuff that you see is pushing closer between 9 and 10% typically.
Great.
And I'd just like to add, I think one cap is obviously the employment situation. I talked to clients that I'd like to expand, but, if I double the size of my building, how am I going to double the number of employees? And I think that's a concern. They're all scrambling for employees right now, and I think that's put kind of an artificial cap on growth right now.
Okay, thanks. I guess now we'll move to the office segment, and I'm going to ask similar questions to Tony and Aaron, but what is your current assessment and outlook for the office market for the Dayton region?
Right now, we're seeing great activity. It's primarily driven in two specific areas, I would say. East, leading that, the Beaver Creek Fairborn, and that's all base driven. I don't know exactly what's going on at Wright Pat, but everyone seems to be out there looking for space. There must be a lot of contracts that are coming due, and we get exercised a lot because you'll have multiple tenants bidding on the same contract, so you never know how many of these will actually come through. But I can honestly say in my 30-some years doing this, I've never seen a tighter, hotter market out in that Beaver Creek Fairborn area than I see today. We've got buildings that are 100% leased where as these leases are rolling over with existing tenants, we're having to go to them and say, sorry, we need to ask you to leave. We've got bigger tenants in the building that are clamoring for space, and we just can't renew you. So that doesn't happen very often, but it's happening now in that Beaver Creek Fairborn area. So that area is hot as hot can be. Seen a little bit of new construction. Synergy's putting up a building for Radiance Technology, a 3-story building where they've got an additional floor. They've put up spec, 17,000 square feet. We're also seeing rents start to creep up in that market really for the first time, where traditionally in the newer buildings, you see rates of $16 a square foot, triple net, meaning you had all the operating expenses on top of that $16. Now we've got some owners pushing that up to $18, $19 a square foot, which you just haven't seen in Dayton ever. It's funny, I tell a story all the time where there's buildings that I represented 30 years ago that I still represent today, where we're quoting the same rent that we were quoting 30 years ago. Historically, we haven't had the demand which allowed landlords to push those rents. You would sign a lease with a tenant over 5 years. There would be a 2 or 3% escalator in that lease, and at the end of that 5-year term, a tenant would come back and say, hey, you're still quoting what I came in here for. Let's lower my lease rate, and landlords have to do it. So it's been very stagnant. I think our numbers will show that. As far as overall vacancy, it's showing 22%, and this was at the end of 18. That number, I'm sure, has come down some. But we still got certain product in the market that just I don't think will ever be leased. Unfortunately, some of the older downtown towers, things like that are just functionally obsolescent, that I don't think will be leased, and those skew those numbers a little higher. There's a good chart that shows, you see the years now. Steve, can you move that up a little bit? It shows the time period, how we've seen a downward trend in vacancy rates to today's 22%. So we're making good progress on that front. Still a lot of space out there for tenants, but it's got to be in the right location, got to be the right type of space is the message. And everybody wants the cool, hip space, the industrial type space for their office environment, and that's not easy to find. So, but things are good. I mean, activity couldn't be better right now. Let's hope there's nothing in the national economy that affects that. Want to add anything, Aaron?
That's perfect.
That's the first.
Either one of you want to speak to the Central Business District, which is always, a topic of conversation in downtown Dayton, and the vacancies that
Yeah,
the trend there?
I could probably do that. So what you were saying earlier, Tony, is right. I mean, you talk about some of the functional obsolescence of some of these towers. The newer towers, and I mean newer like in the 70s, the footprints are large enough that I think that, users are still going to need that traditional space. It's interesting that the older 100-year-old 4- or 5-story buildings that are really the non-typical exposed brick, once were really industrial buildings, are in need and really desired right now. They cost more to fit up. I mean, the TIs are high now, and construction costs are going through the roof. Tenants are willing to pay for it. I'm seeing market rents in the, high 14s and 15s triple net, which is like a $22, $23 deal downtown. And I can't tell you the last time we were doing $22 and $23 deals downtown. I mean, I haven't seen it before in 10 years. So, it's interesting how the user wants to be perceived. But like Tony was saying, location's critical. Downtown's got a ton of space. Landlords are forced to, the tenants want turnkey space, so they're forced to spend the money to get the tenant in there. And if they're not willing to do it, a tenant will say, well, we'll move to the next option then, because somebody else is willing to do it. So there's the challenge is a few things. Number one is how much does it cost to build it out? Where do they need to be, and does it fit for them? And then is a landlord willing to do it? Because a tenant's willing to get it somewhere else. Do you agree with that?
Absolutely, and parking always drives deals as well downtown. That's a big concern for the tenants, obviously. So convenient parking, economical parking, that's why you're seeing some of these new developments going on the periphery where they can offer free parking to the tenants. I think that's going to continue. So that's always a big concern. So.
The problem has been is Dayton has been so suburban for so long that when you have parking, or something like parking, and you come back to the city and you say, well, where do my employees have to walk to? Where do my customers, where do they park? That's the problem. People just don't get, it's not urban yet. It's not urban enough, and people don't realize yet that, hey, I can walk a block to my office. It's not that hard. I can, and I thought that when we had moved downtown years ago, I thought, well, where are we supposed to park it? But you just get over it, you know, it is what it is.
Yeah, you
But,
figure it out.
but that's, you know, and on, you know, back to the floor plates, I mean, some of these larger users, it's hard to go up 3 and 4 flights of steps to get to where you need to go, just to go see your accountant or go see some unit of your business. The suburbs have built it so the floor plates are large enough that you can fit everybody on one floor. It's just efficient, it makes sense. And downtown doesn't have, I mean, I think Kettering Tower, the high-rise is 16,000 feet of floor. I mean, we see stuff at 25,000 feet all day long, so we take a floor and a half. So it just adds to the hair of the deal. It's just a little, you know, it's just a little harder to get done. And it's a little bit harder to find downtown. And certainly the non-typical space, you're not finding 16,000 square feet on one floor. You'll probably find maybe 7,500, maybe 9,000, something like that. So it's a niche market too.
Right, understood. Is there any type of product that, you know, from your perspective, that the marketplace is demanding? I mean, I know there's always going to be a need for Class A, there's always going to be a need for some other, you know, sub-market, I guess, but is there any trend that you're seeing that, you know, the market's kind of demanding that maybe we're not able to furnish or not furnish as well as we would like to?
That hip industrial space is the one that you hear the most about, where people are looking they're all trying to cater to the millennials, the workforce of the future that doesn't work like we all used to work. We all up here, there's a lot of young people out there. But yeah, in fact, our office just went to an open office concept that we're still trying to get used to. We're all came from the private office environment, and there's challenges to be had with that. And taking older buildings and renovate them, people think, well, you're not putting in a ceiling, you're not putting in carpet, it should be cheaper, my lights aren't, et cetera, et cetera. Well, it's not, doesn't work that way. It's actually more expensive to go to that type of office finish than it is to do a traditional office finish. So it's generally more expensive, and the release rates have to mimic that higher cost to get them in there. So that's been the biggest trend. I don't see that changing, is what I hear and read, that this is just what people are getting used to. Now, the pure open concept, I think, that people are trying to, or have figured out that maybe that doesn't work as well. You've got to have some separation or places for people to go to have private conversations or conglomerate, collaborate, thank you, with their teammates, et cetera. But yeah, so I think it's being tweaked as we progress and learn the pluses and minuses of this open environment, but that's been the trend.
Just to add to that, I think that 2008 through 2010, I think that the users or the tenants had this big idea, well, let's save on costs. And that's why they threw up the open concept. I think
Right.
that we used to, we probably considered a typical user would need 250 square feet a person in the way we used to look at things. And then it went down to like 120
Right.
a person, which was just a huge difference. So they're just smashing everybody into this open space and saying, hey, guys, how about that confidential phone call you're about to get? I mean, it just doesn't work that well. So I think that users are saying we're less productive now in these very tight, cramped spaces, and we need we need breakout rooms. There should be some offices. There should be huddle rooms that people can go to if they need to, when they need to. So we're absolutely seeing that trend.
How do you counsel a landlord in terms of, you know, the build out and that type of thing in an office platform?
That's probably a good term, counsel.
Yeah.
You know, so a lot of the space that we deal with is in Dayton, Ohio, in the office, and I say the Dayton region, really, is not first-generation space. So what they're gonna need to do for that second tenant down the line, a lot of this stuff hasn't been touched in 25 years. So at some point in time, it's gonna have to happen. It's gonna have to happen. So it's easier when you got a tenant in tow to say, hey, you can justify doing this now, because we have this tenant, and if they leave in 5 years, well, you've got updated space now, it's not gonna cost you as much. That is the idea. Does that always work? Maybe not, but it's gonna be a lot cheaper than it would have been if he's gotta do it, you know, in 5 more years from now, all over again. So it's a challenge trying to get a landlord to throw the money in necessary to do the deal. And a lot of times there's a hybrid. Maybe the landlord does free rent for a few months and pays a portion of the TIs and maybe doesn't do it all. Landlords would love to see the tenant has some skin in the game, but it's just in this type of market, it's hard to do.
Are you seeing terms lengthen with your lease deals?
Yeah, if I can answer that real quick.
Go ahead.
Yeah, definitely. I think we're seeing terms lengthen, and especially in that east market where you have the defense contractors that we work a lot with, Most of those contracts that they get at the base are 1-year renewable contracts, so they all want flexibility on their leases, where they want, if they lose that contract, they want to be able to terminate that lease. And 4, 5, 6 years ago, it was commonplace that it was just a given, fine, that's just the nature of working in this market, we're going to have to give these termination rights to these tenants. Now, we're telling landlords, hey, don't give it. Let them take the risk. Why should you take the risk? It's their business. It's a tight enough market that we will, if they don't come and they refuse to do it, we'll find somebody else to take that space. So, yeah, we're seeing definitely a trend where you're not being as flexible with some of these tenants and their demands. So.
New construction, are you seeing new product come up out of the ground? And can you speak to the developers or landlords who have the foresight to build a spec office building, or are you seeing that trend in any way?
There's not a lot of it going on in the office market. There's still, like I said, Synergy's putting up a building, 54,000 square foot building out by Wright Pat, where they've got Radiance Technology taking 2 of the 3 floors. So they're speculating on a floor out there. But most of the office deals you're seeing are tenant driven, where they've got a user in tow. Now, south of town, Sherry Oaks is putting up a 20,000 square foot building on Yankee Road outside of her building. That's the first true spec building that I can think of. It's not a big, it's only 20,000 square feet, like I said, but so we're starting to get there. But most of the buildings that have been built are usually tenant-driven, where they've got somebody. Austin Landing, you could say maybe where those buildings were spec, even the most recent one. And that's been a phenomenon we haven't even touched on, that as soon as they put those buildings up in Austin Landing, they seem to get leased. It's, for whatever reason, that's where the financial sector wants to be. We're working with one in particular that's located in Washington Township, and their message to us was, hey, find us a short-term deal until space opens up at Austin Landing where we can get into Austin Landing. They just were that adamant that that's where they have to be in order to recruit the financial advisors that they want to recruit, and they just see it as a great location for clients, as well as being able to attract from northern Cincinnati as well as Dayton. So that area continues to do very well.
We talked a little bit about cap rates when we talked about the industrial market, but can you and Aaron and, also Steve and Jerry, the investment real estate market in Dayton, Ohio, or any sort of news in that regard? Or are you seeing many, other than our retail strip center, but in the office or industrial market for investment real estate?
Well, industrial's probably a little bit better right now than office as far as.
Yes, I mean, there's a lot of people looking for investments out there. You'll find cap rates 7%, for industrial, 7 to 8%. Whereas, boy, when things were hitting the fan, they were 9, 10, or better. Everyone's looking for an investment out there. International customers, national customers, everybody's looking for industrial. And the market's tight, and it's expensive to add inventory, so it's probably a good investment for them, good investment for them long term. So, yeah, if you have an investment deal, it goes pretty good. On the other hand, there have been some mega deals, out by the airport and stuff. I mean, whoever bought the Payless shoes, all of a sudden now they got a big hole. The Bonton building went empty, another big one that an East Coast investor had bought. So I mean, there are some pitfalls, but if you have a 100,000 square foot single tenant triple net leased building, you can see cap rates below 8%.
I mean, the buyers up by the airport, though, I mean, those are institutional buyers. I mean, that's a different dynamic than what we're seeing on the 50 to 100,000 square foot building. And you'll see the lower cap rates like I talked about earlier, but the traditional stuff, I still think it's still in that 9 and sometimes 10%. And oftentimes they are not from the area, but they're private buyers. And, I think the last one I sold, I think it was on the market maybe a month. And if I get an opportunity now, I won't even have to take it to the market. I mean, I have people that I can just go to that I know want something. Mm-hmm. The problem is you can't find a decent deal to sell right now.
Right.
I mean, they're just not out there, so.
Yeah. I mean, the only thing I have to add to that is it's just all about the creditworthiness of the tenant. I mean, you can't really look at a pocket and say, well, the North does so well. It's based off the user, and it depends, somebody's willing to buy it wherever they are. I mean, if the user is a credit-worthy, long-term tenant, then, you know, doesn't matter where they are, but somebody's out there to buy it.
We're getting ready to wrap up. I guess, Aaron, I'll throw a little bit of a curve. Can you speak to the retail market in terms of the Dayton?
Well, retail's, there's really no magic to it. Retail wants to be where people are. They want to be where where the income is. I mean, they like the disposable income. So retail has kind of changed a little bit. I mean, they're really weirdly heavy in the psychographic, you know? I mean, you got the demographic stuff, but the psychographics is like the millennial type, you know, and they look for like they call them latte, you know, drinkers. And I mean, they figure out what type of person is buying their product, so they can really dial in on where they want to be. And I don't know that that's necessarily a specific location.
Right.
It's everywhere. I mean,
Right.
It's just where do they need to be, and they'll find a space. I mean, North has done very well in the Miller Lane area, and that's, as you see, it's a lot of fast food. South and Austin Landing's done very well, and everything kind of in between, southern part of Dayton and all the way to Austin Landing has done very well. So retail is, it's probably the most fickle thing in the world, but they're very, very good at finding where they need to be. And
Okay.
it's as simple as that.
All right, thank you.
Sorry.
That sort of concludes the presentation we had put together, and I guess at this juncture, we'd like to simply open it up to the audience if there's any questions you'd like to ask the panel. Yes, Steve?
A lot of buzz right now about opportunity zones. Do you think with some of the ones that we have in the Dayton region, that's going to drive any new investment, new construction investment? I mean, are you seeing that, investors asking about those?
We don't, here's the question, is we don't know yet enough. And they're too new, it's too broad. And this is just my opinion. I think that in looking at the opportunity zone, the time for the return is 5, 7, and 10 years, and it's better the longer you wait. Who's got 5, 7, and 10 years to wait? So I don't know yet. I guess that's the best answer I have, and it's always progressing, and we're always learning more. But have you had any interaction with opportunity zones yet?
Not from an industrial standpoint. Haven't anybody looking to try to benefit from that.
Yeah, please.
Well, there's certain buildings that have to have.
Did you guys hear that question?
Yeah, man, go ahead.
Yeah, sorry. The question was, do we as a panel, or my panel here, see the city of downtown and the CBD in particular converting to a historical district in an effort to attract historic tax credit? Would that be a fair summation?
So what I was going to say about that is a lot of these older buildings would be torn down without it. You have to have some sort of help, or the financial pro forma will not work. I think you've seen with the arcade and the amount of cost with the historical tax credits and everything else has been, kind of shuffled around that project. You just can't do it with these buildings without it. Imagine the HVAC in these older buildings that are being retrofitted from a lot of these industrial buildings to office. I mean, the HVAC alone, everything's new. The electrical, imagine the electrical, all the lighting. I mean, everything's got to be updated, and it's so expensive that a lot of these buildings, without it, it wouldn't work. It wouldn't work. So yeah, I think it's important. On the flip side, some of the historic, the historic issues you probably would run into is some of the what has to stay in the building. Some of the issues, what to make it historic and to be approved for that, what do we have to keep, and how expensive is it to keep it? for instance, windows or, whatever it might be. So, without it, you can't, it wouldn't work.
But it adds challenges, having it. So, I mean, we're seeing that. Yeah, I think overall positive. You have to be able to deliver the type of space that people are looking today. These buildings can do that, and you just have to understand the challenges that come with it. There's a development that's kicking off, the motor car building behind the Troll and the Pub, back in that area off West Third, that they're redeveloping that Gossager is going to take 2 of the 6 floors, is that 6 floors? Yeah, 6 floors, so there'll be 4 floors that are available, but you look at the windows, and I'm like, holy smokes, you guys are going to have to retrofit these and play. I mean, anybody else would tear them out and put new windows in, but they have to keep those kind of things. So it does add cost, it adds challenges, but without those credits, the developer wouldn't be doing it. So it's kind of catch-22.
Good question.
Mike?
Have you seen a demand from your tenants requesting their tenant or their landlords put solar on the buildings or decided to lock in rates for a long period of time?
There was a trend 3, 4, 5 years ago where the LEED certification seemed to be a hot buzzword, that we would get national companies coming in, and then there were RFPs. They all wanted to know if you were LEED certified, and I guess there was a criteria that they were looking at, but it just never took off in Dayton. So there's very little LEED certification going on, or the green initiatives. So I haven't seen it. Nobody's asked for really much of that lately. It seems to have run its course here locally. Maybe on the coast it's more of a hot item, but here locally we haven't seen it. Now, some of the building owners do it without the LEED certification. They do certain things because it makes sense to do them. But just to go out and get that LEED certification, it's very expensive, and so we just wasn't a trend that caught on here.
I think if we were doing this about 3 months ago in our doldrum gray skies, we'd probably know why we don't do as many solar panels. It's on the industrial side, you don't see it.
The other thing is, what type of lease is it? Who does it benefit? Does it benefit the landlord, or does it benefit the tenant? So if there's a cost savings for the tenant, I could absolutely see them saying, hey, what are our options here? LED lights, is it solar play? I mean, is it geothermal? But if the landlord might say, well, I'll do it anyway because it's going to save me money. And so it just depends on what type of lease you're with and who does it benefit.
Talking about LED, that's probably the biggest thing from industrial is if you're going to save energy, it's using LED lighting and still benefiting from some of the DP&L credits you can get. It really benefits the user. The payback's extremely quick. So oftentimes it's a combination deal with the landlord and the tenant to come up with a means to make that happen, because if you have a user in tow going to get those credits, it makes it much more affordable. But we're seeing conversion of the old T12 or even T8 lights that were more efficient even than T12s going to LED. I mean, that's a big ask, and it saves a lot on energy.
We still have buildings with sodium lights and, the old lights, and when they go to LED, the payoff's like less than 3 years return on those.
Tom?
Yeah, I wonder about industrial trends. You talked about a little bit earlier about the absorption rate of industrial spaces is going up with less and less space available, but it hasn't quite caught up with being able to develop new industrial space. Do you see that trend continuing that way? And if you were to look in your crystal ball, how much further in the future do you see that new industrial space would catch up, that it would be cost effective to do that?
Well, if I had that good a crystal ball, I'd build it myself. It depends on a couple things. What's going to happen with construction pricing? I mean, if it keeps going up, whatever percentage that keeps going up, are the rates of existing product going to go up? And oftentimes, to bring the rates up on existing product, you got to put more money into them. So, I can't tell you. I mean, the market's got to stay extremely tight, and if somebody has a demand, I mean, they're going to have somebody build a building for them. I mean, when you look at really the true cost to an operator, rents aren't. I mean, they may tell you rents are the big thing. It's not. I mean, it's transportation and employment. Those are the two biggest things. What's their shipping cost and transportation? So, this market's been stagnant for so long that people are used to paying a certain number. I mean, we kept our rates the same on portfolios of old Miller Valentine Partners buildings for years. And finally, they're increasing those, and they should. Because the way their lease is structured, you know, it's not a net lease, it's a modified gross, so a lot of things are included. But, you know, we're still not there. And, you know, unless you build that larger building, like we said, going at the airport, and if you have a CRA where you don't have $1 in taxes, that's the only place you're gonna be able to do it. But if, like I said, if somebody has a need and they can't find it and they need to be here, rents aren't gonna hold them back. It's just, you can't do the speculative development.
Anybody else? Cindy?
Did you hear that?
Yeah, just a comment that NIOP is having a seminar, and I think I saw an email on this, sometime in June about opportunity zones, because there are a lot of questions, and you do, I know I get questions from folks about, you know, how they work, and I just haven't had the opportunity to work through the process with anyone, but it certainly is a buzzword in the industry.
I'd just like to comment on Steve's too, on the gentleman's question about new construction and existing buildings. We've been spoiled here for more than 20 years. Our industrial rental rates have been flat, and they're going up, but they're inching up, whereas construction has been racing ahead in cost. So we've been spoiled for more than 20 years on relatively cheap industrial rates, and boy, that's going to take a long time. Construction is just outracing costs. Labor costs, materials costs are just outracing the increases we're getting in you know, existing buildings out here. So, boy, I see that a long time before that ever catches up.
Anyone else? Yes.
Comment and a question. First is a comment as a millennial who has an office with a door who loves it. Not all millennials. But my question was on the commercial side. I know previously we had a lot of companies who kind of chase abatements, and from the landlord's perspective, are they seeing their tenants beginning to renew their leases, or are these companies continuing to kind of hop from place to place?
Well, the CRA is a 15-year abatement, so, you know, they'll sign, even if they sign a 5-year lease, they'll get that abatement for 15 years. You're maybe talking about
You talking about
initial.
office tenant, yeah, you're talking about office.
And are you talking about incentives? Are you talking about incentives with certain cities that have given incentives for office users? Is that what you're?
Mostly that within the landlord that I know that I'm kind of doing a comparison.
Mhm.
This might see some of that with industrial, but for an office that is signing on to a lease, but then may try to go move to another, would they be considered moving to another place within the CBD, or would they be hopefully staying within that same place and renewing without the landlord getting those incentives?
Well, they'll put you through the exercise of trying to find something. And the reason why that happens is because they'll go back to their current landlord and try to renegotiate their rate. So no matter what happens, that will happen. Unless they're just so happy that they say, absolutely, we want to stay for 5 more years and we don't care what you charge us, which doesn't happen.
That doesn't happen. Yeah.
So it's part of the industry, and a tenant is always going to want to see what's out there, and things change. I mean, if you had the crystal ball and you said, well, in 5 years we're going to stay this size and we know exactly where we're going to be, but that rarely happens too. You just don't know. So there might be a space out there that fits them better. You know, do we see a lot of people from downtown that want to move south just because? Not really. I think that people stay downtown and know downtown, they want to stay downtown. I think a lot of people south stay south, know south, they want to stay south. But we are starting to see a lot of people kind of come back to the core. A lot of companies see some synergy here, and I think that, you know, if you would have asked me 5 years ago, I probably would have said, you know, I don't know that it's caught on yet, but I see it now. I truly see it. I hope it continues.
Justin?
Kind of going back to the vacancy of industrial space. from a community perspective, you've got a lot of communities who say, well, if we just had a product, we'd be able to attract a new business in to our community. So they're making investments in either land acquisition, infrastructure to available sites, and in some cases are trying to make a case for spec buildings. Do you, in your opinion, would we be able to, are we losing out on deals because we don't have the available space, or Steve, like you said, if they want to be here and they need it, they're going to build it?
You know, obviously, we'd love for communities to build buildings and have them ready to go. That doesn't happen here that much. It's kind of interesting you bring that up. I just did a transaction in West Virginia, and the community did a partnership with, it was a private-public partnership, and they essentially built a shell of a building. It didn't fit the floor in, you know, they had the shell up, ready to go, and the whole idea was speed to the market. And because they did that, this helped make this deal. It had to be finished, but it cut off, you know, in 4 months, the product could be finished versus 8 or 9. So, hasn't been done here. You know, I don't know if you could do a private-public partnership to try to do that. You'd need to have a CRA to make it attractive from the tax standpoint. But at a minimum, I mean, if you look at the communities that are doing well, you got, look what Inglewood's done, look what Vandalia's done. They controlled ground, they put in infrastructure, they didn't TIF it, so they could offer tax abatement, and they had sites that everybody wanted to go to because of the tax abatement, and the roads were in, and pretty much shovel-ready. Detention ponds were in, common detention. I mean, they've done very well. You don't see as much of that in the South Market. I looked for a client for a couple years ago, and you know, only found a few sites that had a CRA in place. We ended up taking the site, but it didn't have nearly the options. The downside for developers that are out there is, you know, you're competing against municipalities that control ground. You know, in every other market you normally see, developers control a piece of ground, that way they can control building. You know, you have a construction company, build the building, control the site. Get multiple pieces of the deal. Up here, as a developer, why would you control ground when you're competing against a city who oftentimes will give the land away just because they want the jobs and the income tax? So, I think it's something that could be looked into, some kind of partnership. Would it be beneficial? Sure. Now, you're going to build the perfect box? Probably not, but the whole idea is how do you accommodate 75% of the market? Because the other 25% is going to need to build something unique anyway. So, good point.
Anybody else? Well, I've got them captive. All right, with that, I thank you for your time this morning, and I hope you enjoy the rest of your day.
Thanks, everyone.